Hello. In this video, we're going to be talking about sales returns. So when we sell a good, right, we record our revenue and accounts receivable. But then what happens when some of that merchandise is returned for a refund or a credit? I'm sure that we've all done that in the past. I know personally I have. So when we talk about sales returns, it's really sales returns and allowances. And there's a difference between them, but not really between how they're recorded. So when we have a price reduction, when we as the corporation give our customer a price reduction because of the merchandise might be defective. So instead of having them return it to us, we might say, you know what, why don't you keep it, but we'll give you 10% off so the customer keeps it. And so that's called a return allowance. And a return sale, like a sales return, is when the customer actually sends back the merchandise to us and we put it back in our inventory. So I guess the difference between the allowance is that it's not put back into the inventory. But we're going to be focusing on sales returns. When a customer returns the product and wants a refund or in their cash, and then we have to put that merchandise back into our inventory. So the question is, when do we recognize these returns? Do we recognize the returns when they actually occur, or do we have to accrue for them at the end of the period? Let's take a quick example. Let's say I sold merchandise to a customer for $10,000 in December of 2027, and that merchandise cost me $6,000. So I would recognize a $4,000 gross profit in 2027. Now, let's just say in 2028, right, the following year, all of that merchandise is returned. So what happens if I didn't account for any of these returns in 2027, right? Then my 2027 gross profit is overstated because I recorded the full 4,000 in 2027, and my gross profit is therefore understated in the following year in 2028. And also my assets are overstated by $4,000 in 2027 because I either, when I made that sale, I either debited cash or accounts receivable. So either way, my assets would be overstated. So that's not a good way so we can't just record returns when they actually happen. We have to estimate how much of our merchandise that we sold will be returned so that our financials are properly reflected. Let's go through this example. During 2027, its first year of operations, the Hawthorne Manufacturing Company sold merchandise for $2 million cash. This merchandise cost Hawthorne $1.2 million, or 60% of the selling price. The industry experience indicates that 10% of all sales will be returned, which equals $200,000. Which equals $200,000 in this case. During 2027, we had $2 million of sales, and customers actually returned $130,000 of those sales during 2027, right? Sometime during the year, and the company uses the perpetual inventory system, which the perpetual inventory system, in case you don't know, is when the company updates their inventory. For every time they make a sale, they update their inventory. So think about if you've ever gone into a store, right, a clothing store, and you see a shirt that you like, but they don't have the right size out on the floor, and you go to the person that works there and say, hey, do you have a size medium in the back? And they pull out their little mini computer that they carry around with them, and they look and they're like, oh yes, we do have that in stock, or no, we don't have that in stock. Well, they're able to do that because they use a perpetual inventory system. They have the software where the inventory can be updated every time they have a sale or a return. So that's what we're talking about here. So back to our example, let's talk about the initial sale of the $2 million. So, and And in this case, they got cash. For accounting for sales returns, it doesn't matter if you got the cash or the accounts receivable, right? Because this is talking about what we are going to record our sales at. So meaning that if we made a cash sale and returned it, and someone returned it, we would give them cash. If we made a sale on credit and they would return it, then we would reduce our accounts receivable for that amount. But really kind of focusing on the sales revenue in this video. So, okay, let's look. So we made a $2 million sale. So cash, debit cash, 2 million, credit sales revenue. Now, every time you sell inventory in a perpetual inventory system, it's a two-step entry. This is step number one. This is the first step, is to record the actual revenue. And the second step is you have to reduce your inventory. You don't have that inventory anymore, and you have to expense it through your income statement. So here, and that's you have sold that inventory, you have to get rid of it at whatever it cost you. So I'm going to credit inventory 1.2 million because they said that it's 60% of the sales price was the cost. And I'm going to debit my cost of goods sold, which goes on my income statement. So the two-step process. So that's what happened in 2027. Now, also during 2027, of that $2 million, right, 130,000 has been returned of the 2 million. Of the 2 million, during the year, $130,000 was returned. Okay, for cash. And because we sold it for cash, we're gonna give our customers back cash, right, for $130,000. And then we have this account called sales returned. It's a contra sales account, which means it's going to reduce our revenue, our sales account on our income statement. And so we have sales return $130,000. This helps us track how much of our returns have how much of our sales have been returned. So that's step one. So we're reversing a portion of this step one right here. We're just doing reversal for 130,000 of this was returned. Step two is we have to reverse a portion of this, right? Because we debited cost of goods sold for 1.2, but if that amount was returned, 130,000 was returned, then 60% of that, right, is 78,000. We have to book the reverse of that entry too, which is here. So debit inventory. So our inventory increased, right, because someone returned it. So our inventory increases and our cost of goods sold goes down. So now we get to our year-end close, and we're still talking about this $2 million sale, and we expect that $200,000 of it will be returned eventually, of that full 2 million. And that 10% that we estimate will be returned, you can use your industry average. If a company's been around for a while, then they can kind of see year over year what their sales returns are and kind of estimate that way. There's many different ways to estimate that percentage. So in this example, at the end of 2027, an additional $70,000 of sales returns are expected, right? Because we expected $200,000 of returns. We've already booked $130,000. So we're still expecting that sometime in 2028 or beyond, we're going to have $70,000 of returns. So we need to account for that in our year end, in our, let's just say this is 12/31/2027 books. We have to reflect that in our financials. So for the actual 70,000, we're going to debit, our step one is going to be debit sales returns for that 70,000, which is, you'll see when we have actual return, we also debited this account sales return. When we actually had a return and we gave back the money, we credited cash. But in this instance, we're not crediting cash, right? This is what we estimate that we're going to owe when the person or people return my product. So we credit this new account called refund liability, and that's what goes on my balance sheet, right, as a liability. Additionally, my second step is going to be accounting for my inventory. If I'm expecting $70,000 of return, the cost of that is $42,000 because that's at 60%, right, is the $42,000. So I want to increase my inventory by that $42,000 if I'm going to expect it to be returned, but I'm not going to book it to my actual inventory because this hasn't happened yet. So we're going to book an account called Inventory Estimated Returns. This will still go into your inventory balance on your balance sheet. It's just a way of tracking what's actual inventory versus what we expected returns to be. And I have to reduce my cost of goods sold by $42,000. So if you look back at the actual return on step 2, we credit our cost of goods sold and debited actual inventory. And here we're doing the same entry, except we're debiting inventory estimated returns. Let's fast forward to 2028, and let's just say, yes, the entire $70,000 was returned. So we have this liability that we booked in 2027 called refund liability. We don't owe it anymore because we're paying out the cash for $70,000. And we have to, all we're doing here is we're moving basically the inventory estimated returns into actual inventory because now we've actually received those returns. So those items are actually in our actual inventory. So this is really, think of this as a reclass from this inventory account into this inventory account. We've already accounted for the reduction in cost of goods sold for these returns in the previous year. Well, real life doesn't usually work that way, right? We sold 2 million, estimated that, $130,000 was actually returned, and then we estimated that 70,000 would be returned, and that's what actually was returned. That doesn't really happen in the real world, that we estimate to the exact dollar what is going to be returned. So let's continue this, and we say, okay, well, we estimated the $70,000 would be returned, right? So at 12/31/2027, we booked that refund liability of $70,000. This is that same slide when we when we accrued that 2020 that $70,000 liability for expected returns. So we had that refund liability of $70,000 is what we had booked at 12/31/2027. And that's rolling forward to 1/1/2028. And what happened in 2028 is we didn't actually have $70,000 of returns. We only had $60,000 of returns. So when we booked the $60,000, right, we're going to say debit. This is what we would record. Debit refund liability, $60K, and credit cash, $60K. That's this entry right here. And so when we do our T account for the refund liability, right, we still have a remaining $10,000 in our refund liability account. And we have to write that off because that amount does not belong on our balance sheet because we don't owe any more money for these returns from this sales batch, if you will. So we have to reduce our refund liability by $10,000. So here's our first step. Entry number 1 right here is, or I should say, hold on, not to confuse you guys. This is entry number 1 right here, is we have to debit refund liability by $10,000, and we're going to increase our sales returns by $10,000. So the reason why we increase our sales return by $10,000 is, remember in 2027 we debited it by $70,000, but now it's actually it ended up being only $60,000, so we have to credit that sales return account right here by an additional $10,000. So that's step one, that's journal entry number one. This is journal entry number two, and we're going to look at our inventory estimated returns account. And this is our balance sheet account as well. So if you recall, if we go back, we had debited inventory estimated returns for $42,000 in 12/31/2027. But only we didn't only $60,000 of returns were actually made, and 60% of that, because that's our cost, is $36,000. So when we booked this actual $36,000 return, we said debit inventory $36K and credit inventory estimated returns $36K. And that leaves us with a balance in this inventory estimated returns account of $6,000 that we have to reverse, right? We don't have that, should not be there. So we're going to have to credit this account, the inventory estimated returns, and the offset is an increase in cost of goods sold. Because in the previous, for this return, what we estimated, we credited 42,000, but really it ended up only being 36,000. So now we have to debit our cost of goods sold for that amount.